I've sat across the table from people in their 70s who are still working, who didn't want to be, and who told me exactly which decisions earlier in their lives got them to that point. I've also sat down with people who retired at age 45 and never looked back. The difference almost never came down to how much they earned, but usually the subtle mistakes that they didn't even know they were making during their highest earning years. I spent 18 years at Goldman Sachs managing wealth for incredibly high net worth individuals. And now I use the same skill set to help professionals and their families manage their wealth and secure their financial futures. So in this video, I'll take you through the 6 biggest mistakes I see high earners in their 40s commonly making, usually without knowing, how you can avoid them, and what to do if you find yourself falling into these habits. Before we get into the first mistake, though, it's important to understand why it's so important to catch these early, and that's time. Smart investments made early can compound at rates that make an early retirement a very viable option for a lot of people. But on the other hand, poor financial habits formed during the highest earning years can cause huge damage to your retirement prospects years down the line. Building a good retirement plan isn't a one-time activity. It's a dynamic process that responds to the changes of life. And part of that includes catching these mistakes as soon as they appear. So let's get into it. Mistake number 1, having a savings plan, but not a retirement plan. Great as it may be, your 401k is not a complete retirement strategy. Maxing it out is a win, and contributing healthily to it is a really good habit to have during your high earning years. But maxing out a savings account isn't the same thing as having a full retirement plan. I see high earners fall victim to this all the time. They save a bunch of their earnings with no real investment strategy and no real idea of what they want their retirement to look like. Then we see them a few years down the line, unsure of what age they can retire at, how much they can spend each year once they do, and disappointed with how little their money has grown the last few years. So ask yourself this: do you know exactly when you want to retire? Is there an age you have in mind? Do you know how much monthly income you actually want to live on? Does your current savings and investment strategy support this? Do you know which accounts you will draw from first and in what order to keep your tax bill as low as possible? If the answer is to no to most of these questions, then what you have is probably a great savings habit, but not a retirement plan. And those are 2 different things. If you want to get a look at where your finances are and how your current retirement prospects look, you can use our free retirement readiness assessment tool to get an in-depth overview of where you stand. It's completely free. The link is in the description. Mistake number 2, lifestyle creep. Subtle and sometimes unnoticeable, this is a trap that many people in their 40s begin falling into, especially when the busyness of life prevents them from keeping a close eye on their finances. Your income has gone up, your lifestyle creeps up with it. A bigger house, a nicer car, more activities for the kids, bigger vacations. All of it feels justified in the moment because you've worked hard and earned it. But here's the question that matters. Are your savings and investments creeping up at the same rate as your spending? And the answer is often no. A good income doesn't necessarily equal a good savings rate. If you want a real retirement, you need to be saving at least 20% of your income, which includes your retirement accounts. So say you earn $300,000 a year and you're saving 10% of that instead of 20. That gap is $30,000 a year. Invested at 7% return over 25 years, that gap alone translates into nearly $1.9 million. Mistake number 3, no downside protection. For most people, when the market drops, every single dollar they have invested drops with it. That's just how standard portfolio of stocks and funds work. But your investments don't always have to be structured this way. There are investment vehicles built specifically to protect your downside while letting you still capture upside when the markets rise. Most high earners have never even been offered this option simply because most advisors don't have access to it. So shop around, ask potential advisors and wealth managers how they would approach your portfolio management during times of market volatility. Mistake number 4, concentration risk. This is a huge one for high earners or people who work in tech or own their own business. If this is you, there's a good chance that you hold company stock or stock options, which is a great benefit. But be honest with yourself. Is your paycheck, your bonus, and a big chunk of your retirement savings all riding on the same single company? And even if you think you're diversified, you may want to check again. A lot of popular ETFs are more concentrated than people realize, often heavily weighted towards the same handful of large companies. If you think you own 100 different things, you may really be exposed to the same 5 or 6. So if that's you, review your current compensation structure and weigh it against your current investment strategy. Do your investments spread the risk across different companies? If not, consider a renewed investment approach that offers a little more security and diversification. Mistake number 5, an outdated estate plan or insurance. An estate plan and insurance policy that hasn't been touched in years can be dangerous. Ask yourself, is your will actually up to date? Have you had any major life changes since the last time you looked at it? New kids, a new house, a new business, a new account you've opened? Do every one of your accounts have a beneficiary listed and a contingent beneficiary as a backup? We consistently see high earners have accounts sitting with no beneficiary at all or with an ex-partner listed from decades ago. An outdated estate plan does not just cause paperwork problems, it can cause real financial harm to the people that you care about the most at the exact moment that they can least afford to deal with it. A robust retirement plan doesn't just protect you, it gives you confidence that your loved ones will be protected and your assets will be utilized exactly how you want them to be. Mistake number 6, no active tax strategy. This may be the last mistake, but one of the most damaging, being a high earner with no active tax strategy in place. As a high earner, you're paying a significant amount in taxes every year. Most people just accept it as the cost of success, but very few people have a plan to actually legally reduce it. Here's an example. A lot of high earners think that once their income passes a certain point, they're locked out of using a Roth account altogether. For 2026, if you're a single filer earning more than $168,000 or a married couple filing jointly and earning more than $252,000, you cannot contribute directly to a Roth IRA. But you're not completely locked out. Through a strategy called a backdoor Roth, you can still contribute $7,500 a year or $8,600 if you're 50 or older, completely regardless of your income. Many people have never heard of it or used it, but that's just one example. Between tax strategies like that, tax loss harvesting, and being deliberate about which accounts you draw from first in retirement, there's almost always room to legally keep more of what you earn. But none of that happens by accident. It takes a plan, often an experienced professional, to set it up. So those are 6 of the biggest mistakes that we see high earners making in their 40s that have a considerable impact on their retirement years. The good news is every single one of those is fixable, and the earlier you fix it, the more time your money has to work in your favor. If you think you're making one or more of those mistakes and want to talk through your current situation with an experienced professional, you can book a complimentary 30-minute consultation with me and we'll walk through your plans together. There's no obligation. It's just an open and honest 30-minute conversation about where you're at and where you want to be. Now you know which mistakes can cost years of financial freedom. The next step is knowing what tools you have available to solve them. Make sure you subscribe so you don't miss our next videos, where we'll cover the best investment and retirement tips you need to know to have the best financial future that you can.